Good morning, everybody, and happy Labor Day. We have a lot to get to, so let's get to it. We kind of left off last week at, hey, wait a minute, we're getting higher than 1929 valuations. Should we be concerned? Let's tell you a story from 1929. Have you ever wondered how Joe Kennedy made all that money for the Kennedy family? Well, here's the story. He said that he was getting a shoeshine, I think in August or September of 1929, and the shoeshine boy was giving him stock tips. And he thought, if the shoeshine boy is giving me stock tips, this is the market top. And he did sell. He got out. Now, what did he do with his money? Well, it looks like he bought gold. And then he must have had some insider information, which the rich guys often do, that Franklin Roosevelt was going to confiscate gold in 1933 and then revalue the gold after that. So before all that went into place, Roosevelt moved his gold to Switzerland. At the time, it was 20 bucks an ounce, and his didn't get seized. And then in January of 34, Roosevelt revalues it from 20 to 35, and Kennedy, who hadn't lost in the 1929 crash, now had it in gold, saw his fortune almost double again almost. And then he went and bought liquor because he saw that the prohibition was coming in and hey, I can get liquor in through Canada, bring it into the US, and it all blossomed from there. So did he really do the first move based on the shoeshine boy? Probably not. I think what he was probably seeing was flow was drying up. And we can talk all we want about PE ratios or price to book, all these things, the jargon of my business. But the reality is, if more people are buying stocks than selling stocks, stock prices will go up. Now, just because the price goes up doesn't mean the value has gone up. So let's now bring this forward to today. Nothing's an exact match, but are prices going up because stocks are a value or because we just have more buyers than sellers? So who's buying? Well, actually, most of America out there. Every payday, people take money out of their checks and it goes to their 401k plans and it goes into stock investments, bond investments, everything that's on the menu of the 401k plan funds that everybody's allowed to do. And they're all told this is what you're supposed to do because it will save for retirement. You'll get to here. And the market averages this over time. We all know the story. Well, Wall Street knows this. On the 1st and the 15th of every month, a little tsunami of money comes in regardless. Well, what would happen if the flow reversed? What if there were more sellers than buyers? Well, what would cause that? Otherwise, you could rightly say, well, Greg, it'll just go up forever because everybody does it no matter what. Well, a couple of things. First, demographics. We now have an awful lot of baby boomers retiring, and it's the biggest demographic group with the most amount of money. And as they're retiring now and prices are higher, Walt and I are seeing it here in our office. They want to take money out. The other thing that's happening is the economy is slowing down. As the economy slows down, people who are working can oftentimes cut back on their 401k contributions. And then what they're terrified of is what happens if we have layoffs in a deep recession. Now people aren't just not contributing, but they will reach into their retirement funds, even if they don't want to start pulling money out. A couple of more things. Artificial intelligence. We've all heard about this. It's going to replace this many jobs by 2027 or 2030. I'm not sure what the statistics are. We don't know how it's going to play out, but AI is clearly going to take away white collar jobs, especially at the entry level, at least at the beginning. The last one, well, everybody should go get a blue collar job, learn the trades. Have you all seen the robotics stuff? The people working or the machines working inside these warehouses, or a roofer robot that puts together a perfect roof? Things are changing pretty fast. So what would happen when you start to see flow shift like it did in 1929? For the shoeshine boy, he was kind of the last buyer. Who else could afford, if a shoeshine boy could afford stocks, who's after the shoeshine boy? Once there are no more buyers, there were only sellers, and down it went, and it was just a bunch of air. So when is this happening? I don't know. They haven't told Greg in Albuquerque. But what I would say is if you are looking at flow and you are looking at the possibility of a recession and you're thinking, wait a minute, Trump is signaling this, the Federal Reserve is signaling this, they are going to lower interest rates. They don't really want to because they know about the inflation. But if they keep rates high, they could really exacerbate a recession. And that would lead to layoffs, which would lead to all these things we just talked about. I think they've made a choice. They have chosen inflation. They are going to drop rates at the September meeting. They will suffer the inflation, but try not to risk the flow getting reversed because there aren't enough buyers for houses or not enough buyers for stocks that really have kept this economy propped up for a while. So it's kind of a long, windy Labor Day talk, but you are positioned exactly right for the inflation scenario. And I think you all saw it in the month of August. If you didn't look at your statements, at the end of the month, I think you'll be pleased when they arrive in the mail. And with that, I will turn it over to Walt.